All right, so let's begin. And today we'll be talking about retirement planning. We have various investment instruments where one can invest for the purpose of retirement. But then today we're going to talk about specifically retirement mutual funds. And for that, our focus or the fund and focus today is Access Retirement Savings Conservative Plan. And to talk more on this, I have R. Sivakumar, Head Fixed Income Access Mutual Fund. Hi, good evening, Mr. Sivakumar. And we'll be talking about the retirement fund, which is Access Retirement Saving Conservative Plan. So before we get into the nitty-gritties of this fund, I really want to understand the entire concept of having separate retirement-based mutual funds. How different are these funds from a regular mutual fund that your AMC has to offer?
First of all, thank you for having me on. Yes, I think it's a very good question to understand what makes this fund different from others. To be honest, the investments that we make are largely in the same kind of instruments, equities, fixed income, and therefore one might think that it's just another mutual fund. But I think the important thing is two parts. One, from an investor perspective, these funds come in with specific features. In our case, for example, a minimum 5 years holding period. Money is locked in for 5 years at the minimum or until the age of 58. And from the investor perspective, while this is lock-in, but from the fund manager perspective, it really gives a longer runway or visibility of the corpus of the stability, and therefore the fund is able to take a much longer horizon view when it makes its investment decisions. And I think this is a crucial factor when you're designing these so-called solution-oriented funds, that they have specific characteristics which help or guide both the investors and the fund managers to make much more, shall we say, longer-term investment decisions rather than more tactical in nature. I hope that addresses the crucial difference between a solution-oriented fund and a normal open-ended mutual fund.
All right, so I think solution-oriented investment is going to be the big theme going ahead also, which, as investors are also understanding the entire purpose and the way towards they can plan their financial planning. So solution-oriented products are going to be quite in trend. But then just talking about this fund, a very basic question, I really want to understand, because it's a retirement fund, what's the kind of allocation across asset class this fund has?
Right. So what we have done is, actually this fund is part of a family of 3 funds. So there is an aggressive plan, which has a higher allocation to equity. This is a conservative plan, which has 20 to 40% allocation to equity. So relatively smaller, but significant equity allocation. And then there's a dynamic plan, which kind of allocates equity and fixed income on a dynamic asset allocation basis. In a conservative plan, what we're trying to do is to have more of a bias towards debt than to equity. This is therefore suitable for someone who is closer to retirement age than someone who is early in the savings part of your career. And therefore, as you get older, you will need to de-risk your portfolio. So the objective here is that while you get closer to your retirement, either you switch into this fund or you increase your allocation into a fund like this, which then reduces the risk of your portfolio as you get closer to retirement. So when you look at solution-oriented funds, very often you find these packaged in this manner so that you get different risk profiles within the same fund family. And with a conservative plan, the idea is to have a relatively low risk as you get closer to your own retirement age.
All right, so as explained by you, equity is almost 39.5%, debt securities 49.9%, out of which corporate bond is 23.9%, and cash and others is almost 10.4%. Now, see, it's a conservative plan, so it's very important for an investor to understand that there is a time where you need to start investing in funds like these, okay? Just to set an example over here, or maybe you could explain better, an investor has a portfolio of different kind of mutual funds. What and when exactly do you think one should be investing in a fund like this for the purpose of retirement specifically? Now, this is a conservative plan. Do you think closer to the retirement, investing closer to the retirement would definitely make sense to them, because, being a conservative plan, they might just not want to take risk with the entire corpus that they might have accumulated by investing in different investment instruments. So how can an investor time an entry in this particular fund?
Look at your retirement savings in 2 phases, right? The accumulation phase and then your eventual retirement phase. So when you look at your accumulation phase, you want actually higher returns and therefore higher allocation to equity. You have the ability to take risk because you have your regular income from which you're making these savings. But when you get closer to your retirement or in retirement, you obviously want to de-risk your portfolio as you are largely relying on your retirement corpus to live on. And therefore, you will want to de-risk your portfolio as you get closer to retirement age. Now, there's a typical rule of thumb which used to say that your equity allocation should be approximately 100 minus your age. So that means when you're 20 years old, you should have 80% equity. But also what that means is if you're 60 years old, you should be closer to 40% equity, which is kind of where this fund is, right? So this fund is really suitable for someone who is actually getting closer to the retirement age, where the asset allocation of this fund more aligns with this classic idea of 100 minus age to someone who has already made an accumulation and now wants to kind of perhaps decumulate, that is to say, make withdrawals to live on. I think that's what this is suitable for. I'll also make another important point here, which is that while we think of retirement savings as for ourselves, realistically, you have to look at retirement savings also as a means to build wealth because you're leaving it as a legacy. You're leaving it to your heirs. So retirement planning constitutes two parts, for yourself and for your family. So I think you can't have a situation where even in retirement you're at zero equity. You need to have reasonable allocation to equity and reasonable allocation to fixed income. So that's the way we've looked at it. We've looked at it from a perspective, can this fund give a mix of both income as well as growth? And we think an allocation of about 60% to equity, 40%, close to 40% in fixed income. 60% in fixed income and 40% in equity, I think gives a good mix to the investors looking for that kind of risk profile.
All right. Now let's assume an investor invested in a fund like this for a decent amount of time, this fund could also be a part of their accumulation phase. Talking about using the amount for their retired life. Now, how can that be processed or initiated through a fund like this? Could you please elaborate on that?
I think this is again something where people don't really use mutual funds now. One of the things that mutual funds are really good at is managing your taxes when you withdraw. So, for example, we are all familiar with the SIP or the SIP, where you invest on a monthly basis or on an installment basis and building up your corpus. Much the same way, you can also withdraw using what's called a systematic withdrawal plan, SWP, where you withdraw whatever you need on a monthly basis. The beauty of this is that because you're redeeming in fractions, your tax liability is only to the extent of the unit rate. And this fund falls in that greater than 35% equity basket, which means it gets debt with indexation benefit, right? So therefore, there is indexation benefit or long-term capital gains tax benefit to an investment like this. So you can defer your tax because you are only paying tax to the extent of the units redeemed, but also you're getting indexation benefits, which significantly lowers your tax liability. Lastly, of course, your tax liability, even if you were to look at it from a short-term capital gains tax perspective, is likely to be lower in retirement than it is when you're earning. So for all of these reasons, it's useful to look at these kind of products. In general, any mutual fund product, but specifically these kind of retirement conservative plan kind of products, to look at managing your post-tax rates of return once you are in your accumulation or your withdrawal stage of retirement.
Okay. A fund like this can be a better option than investing in a fixed deposit, given the current interest rate scenario. Do you think that's the right comparison?
I think the way we manage this portfolio is we have got an active debt component and an active equity component. The active debt component is running a sort of medium to longish strategy, about duration of a little over 4 years. So that kind of gives you a range of the kind of volatility that you expect on the debt side. It's a 4-year duration. It's not a very long duration fund. As I said, the average maturity, for it's a little over 6 years, which is in line with that expectation of 5 years plus holding period that we expect investors to have at any point of time. And if you look at the equities, again, managed with a longer term. Now, given that there is some equity in this, remember that you can't make any prediction about the expected rate of return in the short term, meaning next 1 year. Markets could go up and down. But if you look at a 5-year, 10-year perspective, the expectation is that the equity should be able to give you some kind of outperformance over fixed income. And this is the historic cycles, right? So the objective for us would be to manage both parts with a kind of long-term focus and the ability to outperform classic savings instruments. And we can do that. And like I said, bring in long-term capital gains tax. I think post-tax rates of return can be quite attractive in the product.
All right. Now, talking about a conservative strategy like your fund, to balance it out, how can one plan their financial portfolio? Maybe if someone is getting closer to their retirement and it's time for them to, maybe just go easy on equity and have more allocation on fixed income or maybe safe assets, how can you balance out your overall strategy when it comes to, being placed in fixed income when you're closer to retirement?
And again, a very good question. And I think you can't have one fund which plays it all for you. So you have to have a strategy where you look at your overall asset allocation. The number one thing that determines returns, total returns over a period of time is your asset allocation strategy. So I think you need to have a good mix of different asset classes. Now, obviously, as investors or as householders, as people working and living, we already have certain assets which we would have built over our life cycle. So you may have a house or you may have other fixed and physical assets, gold, etc. And when it comes to market-linked assets such as bonds and equities, that's where a funds like these or other funds. So a fund like this, which is a 60-40 mix between debt and equity, may not necessarily be exactly suitable for any investor. So what we always tell investors is to please have a financial plan in mind. Make sure that you have a total representation of your portfolio across debt and equity and across the different funds that you have. And so please speak to your financial advisors, please speak to a planning to help you make an asset allocation plan. A fund like this is one hopefully important cog in that whole architecture.
All right, Mr. Sivakumar, thank you so much for being on the show today and decoding all the facts about Axis Retirement Savings Conservative Plan for our viewers today. Thank you.
Thank you.
All right, so that is a safer option for your investment as far as your retirement planning is concerned. But then time to slip into a quick break. Post that, let's talk about a risky investment. And by that, I mean a micro-cap exposure in your portfolio via mutual funds. So what's the buzz about micro-cap that's going on and how can you place it in your portfolio with what kind of exposure and what's the right route to have micro-caps in your portfolio? All of this with Arnav Pandya after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, while investing, mutual funds have to stick with the classification of market capitalization laid down by SEBI in 2017. Now, large caps are defined as the first to 100 companies in the terms of full market cap. Mid caps as 101st to 250th company, and small cap from 251st company onwards in terms of full market capitalization. Now, this is updated twice a year by the industry body AMFI. While there is no SEBI-defined classification of micro-cap, companies that come after Nifty 500 in terms of total market cap are usually considered micro-caps. Over the one-year period, the Nifty 100 total return index has gained almost 10%. Now, compared to this, Nifty Micro-Cap 250 TRI is up 44% and Nifty Small-Cap 250 TRI has risen 28%. Now, a lot of craze and buzz is around micro-cap space. Now, with also because of the brewing interest within the fund managers and AMC community, them launching active and passive funds in the micro-cap space. How can you as an investor navigate through all of this? Let's understand. And with me, I have founder Moneyeduschool, Arnav Pandya. Arnav, good evening and welcome to the show. So clearly the kind of returns that we are witnessing in the micro-cap space, at least what we've seen in Nifty Micro-Cap 250 TRI, it's been up 44% as compared to Nifty 100 TRI. So is this a specific market kind of run that we are witnessing? And also talking about micro-cap, what exactly the kind of industries and space are we talking about?
Good evening, Kavita. So the first thing that you need to understand is that there is no clear definition of micro-cap per se. Hence, it is open to interpretation, but usually as most people understand it, any company after the top 500 companies are considered in the micro-cap space. The second thing is that as an investor, The fact that this space is giving good returns, that is not a reason for you to have exposure to it. Your need to have an exposure to this space plus your risk taking ability, that is what determines whether you should first have an exposure to micro cap or not. And then comes the next question as to how much of an exposure you need to have in the portfolio. So these are the basic things. But as far as the overall market is concerned, it is very clear, and we are witnessing it since the last many months, how there is an overall rise in companies, especially the smaller and the mid cap ones. And this is quite broad based in nature, which is why you are seeing this kind of returns come from the micro cap space. Now, as compared to the large cap or even the mid caps, the micro cap space is technically a very huge basket. And this is more governed by individual companies rather than specific sectors and areas, because you will find that all kinds of companies within that space. This will include everything like what you see in the large and the mid cap space, which would be financials, which would be consumer discretionary, chemicals, all those things. But here, unlike the large and the mid, or even to some extent, some small caps holdings, the sector doesn't determine how the micro cap performs. It is actually a mix of a varied number of individual companies which determine their own course of action, and which determines how they are also performing on the stock exchange.
Right. So currently, the micro cap companies we are talking about, a lot of them is also covered in a maybe a small cap fund. Right now, we have a separate passive fund and an active to be launched. But then, talking about it separately, do micro cap also have exposure in a small cap fund?
No, so definitely, if you look at the definition of a small cap fund, I mean, it is the small cap space is any company after the 250th company, which means that 251 to wherever you take it, 3,000, 4,000, wherever the total number of companies that are there. So obviously, I mean, the entire portfolio of a small cap company will not be within the 251 to 500 companies by market cap range. There are bound to be companies which are beyond the 500 company by market cap. So it is obviously, it is not only obvious, but it is very likely that a significant part or even a part of the portfolio of a small cap fund will have exposure to micro cap companies. And let us now actually clarify this thing, because even when we talk about micro cap companies, these are companies, the top rung of these companies will be those which have a few thousand crores of market cap. So it's not like that they are very, very small companies, but it will be a huge mixture. So the lower down the market cap order you go, the market cap of these companies will also go down. But more importantly, what will happen is that liquidity also is not very high in many of these companies.
All right. Let's talk about specific funds that are launched, on microcap, because one tricky aspect of this space is that investors don't have analysis or maybe research reports, because it's not on the radar of most of these analysts. Okay, but when you talk about a passive fund, what is the kind of exposure investor needs to have in these kind of funds? And because it's a passive strategy, and because we're talking about micro cap, which can be a slightly much more riskier category, but having a passive exposure can just mitigate your risk. Is that true?
So if you look at the passive fund which is already there, which is Motilal Oswal's passive fund, this is based on the Nifty Micro-Cap 250 TRI index, which is an index of 250 companies. So in that sense, the portfolio of this fund will be extremely large because it is replicating the index. So when it comes to micro cap, it is very difficult to predict, or it's very difficult to analyze and say which companies will do well, because these are very smaller companies. And it's, if you just have a very small portfolio which is dedicated to microcaps, chances are that it could be a long period of time before, say, one or two or even any of them perform well. So that requires that if you have a slightly broader exposure, as you can see with this kind of passive fund, you are getting a bigger exposure in the market. This in some sense also reduces the risk for the investor. But the main question remains that when an investor has the opportunity of having exposure to very good companies, well-performing companies with strong balance sheets in various other categories of funds, do they actually need a separate micro-cap fund to add to their portfolio? Because when things are going well, this looks like a very great idea. It will give a boost to the overall portfolio returns. But there will be times when things are on the downside, and at that point of time, it will become a big dragger of your portfolio also. So one has to see that if, for example, you are getting an exposure through micro-cap, through the small cap funds, and you will see that many of these funds have anywhere between 15 to 25% of their portfolio within the micro cap space. So if you are getting that, then do you actually want a separate micro cap fund? It might not be required, even though this is a passive fund. An active fund will have even greater risk element involved, specifically both in terms of portfolio construction as well as on the liquidity side. But this is the first question which every investor should be asked.
All right, now we are also looking at having active placement or active funds in this particular space. Now, if that happens, because it's a very vast space, what kind of strategy you think a fund manager might want to adopt, and how can this be replaced by a small cap exposure in your fund? Can that be done? Go ahead.
So as of now, one fund house has already filed papers for this kind of an active micro-cap fund. This is the Bandhan Micro-Cap fund which has filed its papers. Now, once it comes and it has an NFO, and then how it starts performing and setting up the portfolio, then we know exactly how it plans to put it into action. But even for an active oriented fund, I think that whenever there is going to be an portfolio construction effort, they will have to try and look at a large number of holdings within the portfolio because of these two risks which are there. Unlike the large and mid caps, a particular sector growth is not going to drive a large number of micro caps because a lot of them are completely different from each other. The second thing is the liquidity issue. So even when you are including companies, they will have to take a very small exposure, which by its very nature, it automatically raises the number of holdings in the portfolio. So I would expect that an active micro-cap fund will have a large number of holdings within the portfolio. And if you are looking at replacing this by your small cap fund through a part exposure, that is not a bad idea, because a lot of people now have small cap funds within their portfolio. This is different from having a small cap exposure through either the multi-cap fund route or the flexi cap fund route. Because from what I see in terms of data now, there are actually now nearly more folios in terms of small cap as compared to large cap funds. So a lot of investors already have small cap funds in their portfolio. Some of these small cap funds have a huge asset under management. Like, for example, Nippon India has 35,000 crores of assets under management under its small cap fund. Now, this by itself will ensure that it has a bit of micro cap exposure within the portfolio also. So that itself gives you a micro cap exposure through this route. And similarly, I mean, if you look at several of these 5-6 top funds, which is the HDFC small cap fund, Kotak small cap fund, DSP small cap fund, all of them have some bit of micro cap exposure. So people already investing in small cap funds, they don't need to do anything separate because they're already getting an exposure.
Now, one very important aspect, people invest in equity through shares and also via mutual funds. Now, explain to us, how can you balance out the exposure via direct shares and through mutual fund also in the micro cap space?
So the logical idea is that you don't want to keep investing in a particular asset class through different means where the exposure is the same. So if, for example, your mutual fund is having the same exposure as what you have directly through stocks in your portfolio, it is just replicating it and it's actually increasing your risk, not decreasing it. So when it comes to the micro cap space, it is most likely that if you have some holdings through the direct equity route, it's most likely that your mutual fund might not have those same holdings within their top holdings in the portfolio. So you might have 1 or 2% exposure to maybe 1 or 2 of them if you are anyways having a large amount of direct exposure. But the main thing here is that one should look at the mixture of both your exposure through mutual funds and your direct stock exposure to see what is the total level of exposure to micro caps that you have, because it should not be that within your direct equity portfolio you are loading up on micro caps and it's good because the portfolio is doing well. Similarly, you have a higher exposure to small cap funds within your mutual fund portfolio. This increases the risk. So whenever you are looking at risk management, it's very important that you consider your entire investment in all the areas and then see what is your exposure to various market cap segments.
All right, so this was all about micro caps. Thank you so much, Arnav, for being on the show and helping our viewers with the way ahead as far as micro cap strategies are concerned. Thank you. Time to slip into a short break, but then before that, as we inch closer to the deadline for adding nominees for DMAT and mutual fund schemes, here are the do's and don'ts. My colleague Snehi giving you all the details on this.
Well, that's right. Here's an important update for all of you who have mutual fund investments and DMAT accounts. The deadline for stating the nomination for both of these accounts is on the 30th of September, which is fast approaching. All individual DMAT account holders as well as mutual fund investors need to nominate a beneficiary or opt out of this step by submitting a declaration form. Now, if you fail to do so, your DMAT accounts and folios will be frozen and you will not be able to redeem your investments. You can, however, continue to invest in the existing folios. This mandate applies to both new as well as existing investors according to SEBI. Now, you may ask, why is this being done? Now, the move is aimed at helping investors to secure their assets and pass them on to their legal heirs. Make sure to note that a nominee does not equate to a legal heir. A nominee is solely the trustee of the asset unless a will specifies his or her name as the legal heir. What would you do if the folio is jointly held? Well, in that case, the nomination requires the consent of all the joint holders. To update mutual fund nominations online, you can visit the mutual fund house's website or the NS website. So get to this crucial nomination if you haven't done so already.
Welcome back. You're watching The Money Show. I'm Kavita Thapliyal. Now, there are a plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria one should look at? To help you navigate through this maze, we have Pankaj Matpal today, MD, Optima Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 8657974571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Pankaj, and welcome to the show. I have our first viewer online with me, Nitin Pagare. Nitin, hi, good evening. How are you doing?
I'm fine, ma'am.
All right, so we have a portfolio. You've been investing on behalf of your wife, it seems?
Yeah, ma'am.
Okay. Kotak Emerging, Axis Long-Term Equity, and you want to increase your SIP by 6,000. You are investing 3,000 right now. You also you want to invest in Invesco Small-Cap ICICI Proof Focused Fund. Time horizon is 7 to 8 years and the target is 15 lakhs. 6,000 is the maximum you can increase your investments up to?
I can step it up. I can increase it also.
All right. Any specific goal that you have in mind after 7 to 8 years?
Nothing such as just to invest. Investing in her name also.
All right. Pankaj, do you think he needs to diversify more in his portfolio?
Kavita, good evening. Yeah, I agree with you. See, he has two funds and both the funds are good. But if you have investment horizon of 6 to 7 years, or what he has mentioned, 7, 8 years, so I think you should have more large cap and some allocation mid cap, but small cap should be avoided for 7 to 8 years investment horizon. If you are planning for something more than 10 years, then definitely I'll say that some allocation in small cap, and that too 10 to 20%. But as you have mentioned, as you are saying that you want to add small caps, my suggestion that you should stick to large and mid cap funds or large cap funds or maximum flexi cap fund you can have in your portfolio. So I'll suggest some scheme also to you. You can consider Motilal Oswal large and mid cap fund and ICICI Prudential flexi cap fund. And as you want to increase 6,000 rupees, so I hope that with this, with your existing investment plus 6,000, you may achieve your financial goal, what you have decided.
All right. So Nitin, these are the funds for you. You can diversify your portfolio further. Pankaj, what should be the ideal SIP amount every month to have 15 lakhs in 7 to 8 years?
See, if we assume 12% CAGR, so in 7 to 8 years, though I'll say that expecting 12% is also a little optimistic, because longer the horizon, we can expect the better returns. But still, if I calculate at 12%, so if he invests, say 15,000 per month, then he can achieve his goal of 15 lakh in 15 years. I said, you said, or before that?
No, 15 lakhs in 7 to 8 years.
Yeah, 15 lakhs, 7 to 8 years, then 25,000 per month he should invest.
25,000 per month. Okay.
Yeah.
Nitin, so the target to step up your SIP is up to 25,000, but so far just stretch as much as you can, and you've got the name of the funds. Anything else you want to ask Pankaj?
Thank you, ma'am.
All the best. We move on, and I have Mr. Godwin with me, and he's calling us from UAE. Hi, good evening, sir. How are you doing?
Good evening. I'm fine. How are you?
I'm doing good. Thank you. Thank you so much for sending us your question. All right. So you can see the funds that you have in your portfolio: Mira Asset Emerging, you have Canara Robeco Emerging, Kotak Emerging, SBI Small Cap, PGI Mid Cap, Canara Robeco Small Cap, also a blue chip fund of the same fund house, and you have Parag Parikh Flexi Cap. Sir, I just wanted to understand, you are investing 50,000 per month in these funds. Is this a portfolio that you've gotten consulted through a financial planner, or you've made it on your own?
I've made it on my own. I've been investing for quite some time. I have a corpus of about 50 lakhs in these mutual funds. See, I have fixed deposits also. So what my plan is my goal is to have a retirement corpus of 5 crores in about 8 to 10 years. Okay. And I need I want to know the quantum of monthly SIP required for this and the funds in which I can invest. And if these funds that I have currently are okay to continue, or should I move on to some other funds?
All right. One last question, and then I will move on to Pankaj. 5 crore corpus after 8 years that you have set a goal for yourself. Is this also the amount you will be drawing regular income post-retirement?
Yes, not exactly, but this is, see, basically my allocation that I want is 40% into equity. Currently, I have only 10% into equity. So I want to increase this to 40% into equity, so I can draw it from my fixed income, or I can draw it from here as well.
Sure, got it. Okay. Over to you, Pankaj.
Yeah, see, I did a calculation. I didn't have idea about their current corpus, but as you mentioned that 5 crore rupees in 8 years, so assuming a 12% CAGR, the calculation comes to 3,20,000 per month. Now, because you have said that you already have 60 lakh rupees, so you can expect that it will be at least double you can expect in 8 years. So that will give you some cushion. But still, you should you are investing only 50,000 per month. That will not be sufficient. You should at least increase to 3 times, means at least 1,50,000 to 2 lakh, if you invest every month, then you can expect 5 crore, because the time horizon is not very long. See, longer the period, it becomes easier because of power of compounding. But here in 8 years, you want to accumulate 5 crore rupees. So your monthly SIP has to go up. And all the schemes are very good. You can top up these schemes, but I'll suggest you 2 more schemes you can consider. One is ICICI Prudential Value Discovery Fund that can be considered, and also one Motilal Oswal Large and Mid Cap Fund. So along with the existing schemes, what you have in your portfolio, 2 more schemes you can add, but per month, the SIP amount you will have to increase. Though you said you have FDs also, so that will also add some value to your investment. But still, as much as possible, you should increase.
All right. Is there anything else that you want to ask, Pankaj?
Should I invest in index funds or ETFs in this, 3,20,000 that is required? So should I also monthly invest in ETFs or index funds? And if that, what are the funds that you recommend, index funds?
Pankaj, do you think a passive strategy is needed, or he's very well diversified as far as active strategy is concerned? But then will a passive add more to his profits?
See, already you have good funds. You have been exposure to large cap also. But if you want to add, then I'll suggest you add only large cap index fund like Nifty 50 or Nifty 100. So Nifty 50 like ICICI Prudential Nifty 50 or IIT Birla Sun Life Nifty 50, any Nifty 50, because you know that passive funds will deliver returns almost same as the index they are targeting. You can consider Nifty 50 or like Axis Nifty 100 index fund. So stay with large cap only, but some amount you can allocate in that if you want.
All right, Mr. Godwin, all the best for your investment portfolio. We move on, and the next question is of Rahul Sinha, and time horizon for his investment is 3 to 5 years. Goal is to invest for short and long term. And he has the money, but he doesn't know how to invest. So the portfolio is almost 1.5 lakh, and he wants you to suggest mutual funds, 1 lakh to 1 crore for long-term investment. That is his question, Pankaj.
Kavita, it's not very clear that how long, because it's short and long term. So if you are considering like short term, even 3 to 5 years also, I'll say it is short term only when you consider mutual funds. So, and considering the market situation at this moment, I'll suggest that to a new investor, they should start with hybrid funds, and balance advantage fund is a good category of hybrid fund. So like ICICI Prudential Balance Advantage Fund, or again, IIT Birla Sun Life Balance Advantage Fund, Motilal Oswal Balance Advantage Fund. This kind of funds are good to start with. But if you are talking about the long term, minimum 5 years and above, or if your horizon is 10 years, 15 years, something like this, then well-diversified fund which have allocation across large cap, mid cap, small cap can be considered. And if I talk about multi-cap fund, then like Nippon India Multi-Cap Fund or IIT Birla Sun Life Multi-Cap Fund can be considered. So again, long-term means when you are thinking about at least 5 years and above, then you should consider diversified funds.
We move on. Narendra Mishra, next question. He says he's 37 years old and he wants to get 5 crores in next 15 years. And that's what his retirement plan is. He is investing in 8 funds. SIP is almost 35,000, Pankaj. Since last 2 years, he's been investing HDFC Flexi Cap, HDFC Mid Cap Opportunity, Nippon India Multi Cap, Nippon India Small Cap, ICICI Pru Value Discovery Fund, Nippon India Growth Fund, Quant Small Cap, Parag Parikh Flexi Cap. These are the funds in his portfolio, and he wants to know whether he can achieve his goal via these fund mix.
See, funds are very good. Though number of funds are little high, but still I'll say funds are good. He has well-diversified portfolio. But if I do a calculation at 12% CAGR in 15 years with 35,000 rupees per month SIP, it comes to around 1 crore 67 lakh. So it is far away from his target. He'll have to increase his this thing SIP. But as he has 15 years long period, if he step up his investment, then it is possible. So keep on increasing your SIP amount year after year. But funds are good. Continue with these funds.
right, so you want him to continue these funds, but considering there is no overlap in his portfolio, should he be adding more funds? Because if he does, there could be an overlap. What do you say?
See, definitely when you talk about two mid-cap fund, the stocks have to be from the 150 universe of 150 stocks. If you talk about large cap, these have to be 100 stocks only. But still, because of weightage of the stocks, etc., sometimes performance changes from one scheme to another scheme. And he has already invested. So I will not suggest him to stop right now. But going forward, when he reviews his portfolio from time to time, at that time he can consider that. But as of now, because all the schemes are good, so I'll not suggest him to stop SIP in any one of these. He can continue right now.
That is time to end the show. Thank you so much for being on the show today, helping our viewers with their mutual fund portfolio queries. And on that note, time to sign off, but I'm going to leave you with our WhatsApp number and email ID. 8657974571 is our WhatsApp number. Email ID, themoneyshow@etnow.tv, where you can send us your questions. Thank you so much for watching. Goodbye.